Every driver believes the same thing about a repair shop. Cars break down, people need them fixed, so the mechanic down the street must be making money hand over fist. Waiting rooms full, parking lots packed, phone won't stop ringing. Must be nice. Here's the twist. A shop can be booked solid for 6 months straight, every bay full, every tech working overtime, and still be quietly going broke. Being busy and being profitable turn out to be two completely different numbers in this business, and the gap between them is where most auto repair shops actually live or die. I actually folded the twist line into part 1 already. It's the second paragraph. Here's the twist. A shop can be booked solid, since the word allocation table treats cold open cum twist as one combined 3-fincham segment, 110 words total. I wrote them together rather than as two separate pieces. If you'd like the twist line pulled out and punched up on its own, here it is standalone. Here's the twist. A shop can be booked solid for 6 months straight, every bay full, every tech working overtime, and still be quietly going broke. Being busy and being profitable are two completely different numbers in this business. So how does someone actually get into this business? There are really two doors in. Door 1, go independent. Rent a building, buy some lifts and diagnostic equipment secondhand, hang a shingle, start turning wrenches. You can technically open a bare-bones shop for a fraction of what Door 2 costs, but you're starting with zero brand trust, no supplier pricing power, and no playbook. You're building the plane while flying it. Door 2, buy into a franchise. And this is where the numbers get interesting. Take Christian Brothers Automotive, one of the biggest names in the space. Total investment to open one location runs between $530,000 and $680,000. Read that again. Over $500,000. And that's before you've fixed a single car. Inside that number sits a $135,000 franchise fee alone, split into a $85,000 down payment and a $50,000 installment due before you even get your certificate of occupancy. Now here's the part most people considering a franchise don't fully absorb. The royalty structure isn't a small slice of gross revenue like a typical franchise. It's 50% of monthly net profit. Not 5%, not 10, half. Whatever the shop clears after expenses, the franchisor takes half of it every single month, for as long as you own the location. Most new owners don't pay that $500,000 plus in cash, obviously. Around 82 to 83% of the investment is typically financed through an SBA loan over 10 years, which means before an owner sees $1 of real personal profit, they're often carrying a decade of debt service on top of that 50-50 split. So the pitch sounds appealing on paper. Proven systems, marketing support, and established name customers already trust. Financing help to lower the cash you need up front. And for the right operator, in the right market, it works. But strip away the polish and what you're really buying is a business where the bank owns a decade of your cash flow, and the franchisor owns half of whatever's left over. Compare that to the independent route, where you keep 100% of what you make, but you're on your own for financing, brand building, and supplier relationships from day one. Neither door is free. One trades money for structure. The other trades structure for control. And the choice you make here, before you've even opened, quietly decides how thin your margins are going to be for the next 10 years. Once the doors are open, the money comes in through more channels than most customers ever think about. And each one has its own margin, its own trap, and its own way of quietly deciding whether the shop survives. Start with the obvious one, labor. This is the layer everyone assumes is pure profit, because customers see a number on the invoice, say $140 an hour, and picture the mechanic pocketing most of it. That's not remotely how it works. The national posted labor rate for independent shops now runs somewhere between $120 and $159 an hour. But the technician actually turning the wrench, their loaded cost, wages, taxes, benefits, insurance, everything, often lands around $35 to $45 an hour. On paper, that spread looks enormous. Charge $140, pay $40, pocket $100. Except that math only works if the technician is billing every single hour they're on the clock, with zero comebacks, zero diagnostic dead ends, zero waiting on a part that didn't show up. In the real world, they're not. Shop productivity, the ratio of hours actually billed to hours actually paid, is where that beautiful spread on paper gets eaten alive before it ever reaches the owner. Second layer, parts. This is the largest single expense on the books, typically 30 to 40% of total revenue. And it's also where shops build in a real markup, commonly 40 to 60% over what the shop paid the supplier. Sounds great until you remember every missed vendor credit. Every duplicate charge, every pricing error on a parts invoice comes directly out of that margin. It's not glamorous, but it's also not automatic. Somebody has to catch those errors, invoice by invoice, month after month. Most shops don't. Third, diagnostics. This one barely existed as its own line item 20 years ago. Now with cars running more onboard computers than a lot of small offices, a diagnostic fee averaging around $120 has become its own quiet profit center. A fee for the shop simply figuring out what's wrong before anyone touches a wrench. Fourth, and this one's newer, EV and hybrid service. Shops that have invested in the training and equipment to work on electric and hybrid vehicles are seeing about 15% higher revenue tied to that capability. It's a frontier layer. Most shops haven't built it yet, which means the ones that have are quietly pulling ahead of every competitor, still treating the EV wave as somebody else's problem. And then there's a fifth layer that never shows up on a single invoice, never gets billed to a customer, and yet decides more outcomes than any of the first four combined. The owner's own uncounted labor. Picture an owner spending 10 to 15 hours a week just reconciling invoices, chasing down vendor credits, matching parts receipts to repair orders. The unglamorous back-office grind of running a small business. At even a modest $100 an hour of their own time, that's $6,000–7,000 a month that never appears as a line item on the P&L. It shows up somewhere else instead, in the owner's quality of life, in the hours they're not spending growing the business, in decisions made exhausted at 11 at night instead of clear-headed at 9 in the morning. Put all 5 layers together, and you get the number that actually matters, the one that separates a shop that looks busy from a shop that's actually winning. Net margin. Industry-wide, independent shops average somewhere around 6 to 12% net profit. Some data pins the true average closer to 6.3%. And yet well-run shops using the exact same labor rates, the exact same parts markups, operating in the exact same industry, are clearing 20% or more. That's not a small gap. That's a 14-point spread between two shops that, from the parking lot, look completely identical. So what's actually different? It's almost never the headline numbers, the labor rate, the parts markup. Those tend to cluster pretty tightly across any given market. It's what happens in the cracks between them. It's whether someone caught the vendor's pricing error last Tuesday. It's whether the shop's effective labor rate, what customers actually end up paying after discounts, comebacks, and underpriced jobs, sits within 5 to 10% of the posted door rate, or whether it's quietly leaking 20% below it because nobody's tracking the gap. It's whether the owner's 15 hours a week of admin time is actually being spent catching those leaks, or just keeping the lights on. This is the part that breaks the naive assumption from the very start of this video. A packed parking lot means demand. It says nothing about whether that demand is being captured, or whether it's leaking out through 5 different cracks nobody's watching. 2 shops can bill the identical number of hours this month, charge the identical rate, buy parts from the identical supplier, and one walks away with 20 cents of every dollar while the other is lucky to keep 6. Revenue isn't the hard part in this business. It never has been. The demand is real, it's constant, and, as we'll get into, it's actually growing every single year as the average car on American roads gets older and needs more work done to keep running. The hard part is what happens to that revenue on its way to becoming profit. And that's exactly where the next problem starts. Because there's one single input that determines how much of that revenue a shop can even capture in the first place. And it isn't parts and it isn't marketing, it's people. Or more specifically, the growing shortage of the very people this entire business depends on. Here's the problem nobody puts on the brochure when they sell you a franchise, and it isn't rent and it isn't parts prices. It's technicians, or rather, the shrinking number of them. Ford's own CEO has said publicly that his company alone has 5,000 technician jobs open, Six-figure jobs sitting empty that it simply cannot fill. And that's a manufacturer. With all the training pipelines and brand pull a company that size can bring to bear. Now zoom out. Dealerships and manufacturers only handle about 30% of the country's repair volume. The other 70% runs through independent shops. The very businesses we've been talking about this entire video. And they're drawing from the exact same shrinking pool of qualified labor, with none of Ford's resources to fix it. So follow the chain one link at a time, because this is where a shop stops being a busy shop and starts being a shop quietly circling the drain. It starts with capacity. A shop's revenue ceiling isn't set by how many customers want an appointment. It's set by how many technicians are physically standing at a lift. A shop with a 6-month waiting list and 3 empty bays isn't a thriving business. It's a business that's already hit its real limit, and every customer past that limit is just going somewhere else. Demand stopped being the constraint. Headcount became it. Next link. To keep the few good technicians they do have, shop owners have to pay up, and they are. Loaded labor costs have been climbing steadily, chasing a labor market where a skilled tech has 3 shops calling before they've even updated their resume. That's a direct hit to the one revenue layer that's supposed to carry the highest margin in the entire business. Remember that beautiful spread from the last section. Bill $140, pay $40. Every dollar an owner adds to retain a technician shaves straight off that spread, with no corresponding increase in how many cars get fixed. Third link. The owner now faces a choice, and it's a bad one either way. Raise the customer-facing rate to cover the rising labor cost, and risk losing the price-sensitive customers straight to the chain down the street with more marketing muscle and thinner overhead per location. Or absorb it and watch a business already averaging 6 to 12% net margin get squeezed toward the bottom of that range, or below it. And here's the part that makes this genuinely structural, not just an annoying cost pressure. It doesn't take a recession. And it doesn't take a bad quarter of walk-in traffic to tip a shop over. It takes one technician. One skilled tech who gets a better offer across town and gives 2 weeks' notice is enough, on its own, to swing a small shop from profitable to underwater within a single quarter, because that one person might represent 20–30% of the shop's total billable capacity. There's no slack in the system to absorb it, no bench of qualified backups waiting in the parking lot. Now add the final piece, the one that should make this worse, not better, and yet somehow makes owners feel safer than they should. The average car on American roads today is 12.8 years old, the oldest fleet in the country's history. Older cars need more repairs more often, which sounds like it should be fantastic news for a repair shop, and in one sense it is. Demand keeps climbing every single year. But demand climbing against a labor pool that's shrinking doesn't translate into more revenue captured. It translates into longer waits, more frustrated customers turned away at the door, and even more pressure on the handful of technicians a shop still has, pushing them closer to burnout, closer to that resignation letter, closer to being the one departure that breaks the whole model. This is the trap. It's not that business is bad. Business has never been better, actually. That's exactly what makes it so deceptive. It's that the one input standing between fully booked and actually profitable is the one input the entire industry is running out of. And unlike parts prices or rent, you can't just pay more of it into existence. There aren't more technicians to hire. There's just more shops competing for the same shrinking number of them. And that competition is precisely what nearly took down a company you'd assume was too big to feel it. Let's talk about the company that should have been proof this business scales beautifully. Instead, it became proof of exactly the opposite. Pep Boys, Manny, Mo Vajak, opened its first store in Philadelphia back in 1921. A Navy veteran named Emanuel Rosenfeld and his partners started with a single shop on Broad Street. And over the following decades, it grew into one of the biggest names in American auto repair, eventually trading publicly on the New York Stock Exchange. Then at the end of 2015, Pep Boys became the prize in a genuine corporate bidding war. The Japanese tire giant Bridgestone had a deal in place, and Pep Boys had underperformed its peers for the better part of a decade, averaging same-store sales declines of around 1.6% a year. That's when Carl Icahn stepped in. Eakin kept raising his offer, eventually structuring a bid guaranteed to beat Bridgestone by 10 cents a share, up to a cap of $18.10. Bridgestone walked away. The final deal closed at $18.50 a share, roughly $1.03 billion in total equity value. A billion-dollar bet from one of the most famous activist investors in American finance on the idea that auto repair, done at scale, was a money machine. Read that again. Over $1 billion for a chain of repair shops. Fast forward 10 years. This past July, Icahn Enterprises agreed to sell Pep Boys, the same company, the same brand, the same nationwide footprint, to Mavis Tire, a private equity-backed competitor. The price, $700 million in cash. Let that sink in. $1 billion acquisition, sold a decade later for $700 million. That's roughly a third of the original price gone. Not adjusted for inflation. Not accounting for everything spent trying to fix it along the way. Just gone. And Pep Boys wasn't even the worst part of the story. Around the same time Icahn bought Pep Boys, he also picked up a smaller auto parts chain called Auto Plus. That bet didn't just underperform. Auto Plus filed for Chapter 11 bankruptcy outright in 2023, with Icahn pointing to softened demand, supply chain disruption, inflation, and the lingering effects of COVID. Here's the detail that connects this straight back to everything we've just walked through. Under Icahn's ownership, Pep Boys leaned harder into repair and tire service while closing down its retail parts stores. And even that pivot couldn't outrun the pressure. Icahn Enterprises' auto segment posted a 3% revenue decline in 2025, down to $1.4 billion, which the company attributed partly to the strategic closure of underperforming locations and reduced consumer spending on repairs and maintenance. Think about what that actually means. This wasn't some scrappy independent shop that couldn't get financing or didn't know how to price a job. This was one of the best capitalized names in the entire industry, backed by one of the most aggressive deal makers on Wall Street, with every resource money can buy. Corporate scale, brand recognition built over a century, professional management, access to capital markets, an independent owner could never dream of touching. And it still couldn't escape the same trap we've spent this whole video describing. Scale didn't fix the labor bottleneck. It just multiplied it across hundreds of locations at once. Every one of those Pep Boys stores was fighting the same shrinking pool of qualified technicians as the single-bay independent shop across town. And a corporate logo doesn't make a technician appear where one doesn't exist. The lesson here isn't that Pep Boys was mismanaged, or that Icahn made a bad call in 2016. The lesson is bigger and considerably less comfortable. If a billion-dollar operation with 100 years of brand equity and unlimited access to capital can watch a third of its value evaporate chasing this business, then busy was never the thing that mattered. It never was. What actually decides whether a repair business is worth anything 10 years from now isn't how many cars pull into the lot. It's something almost nobody outside the industry ever thinks to ask about. So picture the two owners this business actually produces, because it does produce both, side by side, in the same towns, charging the same rates. The best case looks like this: an owner who treats the invisible layers as seriously as the visible ones. Someone who tracks the gap between the posted labor rate and what customers actually pay, and closes it. Someone who caught the vendor pricing error last month instead of eating it silently for the 4th year running. Someone who saw the EV wave coming 2 years early and got the training done before it became mandatory, instead of after it became a crisis. That owner isn't running a bigger shop, they're just running a tighter one. And they're the reason 20% margin shops exist at all in an industry that averages 6. The worst case looks like Pep Boys, just smaller and quieter. An owner, or a franchise, or a private equity roll-up chasing the same idea at scale, who assumes the waiting list is the whole story, who pours capital into more locations, more marketing, more square footage, and never once fixes the one input that was always the actual bottleneck. That owner can be busier than ever and still be a single resignation letter away from the numbers going upside down. Same industry, same demand, same rising labor rates. Completely different outcomes. And the difference was never about how many cars showed up. So here's where that leaves us, back where we started, with that packed parking lot and that ringing phone. Every driver who's ever waited 3 weeks for an oil change assumes they're looking at a business printing money. What they're actually looking at is a business running as fast as it can, on a labor supply it doesn't control, toward a margin most people would consider embarrassingly thin. The shop that's always busy and the shop that's about to close are, more often than anyone wants to admit, running the exact same numbers. The only thing separating them is how many technicians showed up for work this week.